My name is Brian Biggs. I'm the Vice President of Research at Grosvenor Property Americas. We're an integrated institutional real estate investor that does debt and equity in the United States and Canada. We have offices in San Francisco, Washington, D.C., and Vancouver, and we're also active in the Seattle market. No, I wouldn't say it has, because our article was focused on the supply side of real estate, especially the supply side of residential and in particular apartment markets. That's a really slow moving dynamic. And so we wouldn't expect to see any changes in kind of a month to month context. But Q2 was probably the high water mark, both in terms of rents and home prices in the markets that we analyzed. Home prices look to have turned somewhere in between kind of the April to June mark, and it looks like rents on a quarterly basis also started to come off in Q2. It remains to be seen how far that process goes, but we did highlight that some of these markets that were seeing quite a lot of supply come on were at risk of seeing a pricing correction. We're starting to see that on the rent and on the home side. Where we're not seeing any action yet, but the data is available with a lag, is in the institutional apartment sales side. So cap rates, price per door, et cetera. We've not seen that change yet, but we do anticipate to see that going forward. So our apartment outlook in 2023 is to see a deceleration from the blistering pace of growth that we saw over the last couple of years. We do continue to expect modest rental growth to the tune of anywhere between, call it 2 to 4%, depending on what market that you're looking at. But we also expect interest rates to put pressure on cap rates. A lot of markets right now are experiencing negative leverage, meaning the cost of financing apartment acquisitions is actually higher than the going in and sometimes the stabilized cap rate. So we expect financing costs to put downward pressure on apartment prices, but we don't expect rents to slow from next year as such. We do, however, expect rents to start maybe slowing, perhaps even contracting, starting maybe late 2023 or early 2024, consistent with our expectation of a recession beginning sometime in perhaps late 2023 or early 2024. I wouldn't say we've seen differential impacts as of yet. That is to say, again, our article focused on the supply side of real estate markets. I don't think we've yet seen the clear out that we would expect associated with short-term oversupply in those sunbelt markets as compared to the gateway markets yet. I do expect to see that as and when we enter a recession. If we enter a recession, if we start to see job losses, we'll start to see some decisions around where companies want to locate workers, where they want to continue to be in satellite offices or consolidate back in headquarters, which tend to be more in the gateway markets. Our expectation is that we will probably see more consolidation into core headquarters space, potentially shutting down some of those more satellite offices, or potentially making decisions to pull back from remote work. Not to say that remote work is going away, definitely not. We do expect to see that sort of elevated levels of remote work continue, but we don't expect to see any material differences between Sunbelt and gateway markets until we see the economic cycle turn. We're not quite there yet. So one trend we've noticed since really pre-pandemic and accelerating during the pandemic was what we call the flattening of risk in apartment markets. That is to say, the spread between the highest yielding major institutional apartment market and the lowest yielding institutional apartment market has been compressing. What that means is that investors have the same or are pricing the same risk on a cash flow in, say, Phoenix or Austin as they are in, say, San Francisco or Washington, D.C. or Seattle. We wonder whether this is here to stay. That is to say, changes in working patterns, changes in capital availability, changes in capital depth and comfort level in some of these sunbelt markets have changed such that the risk associated with apartment cash flows in those markets are comparable to what they are in major gateway metros, or whether it's a sign of a bubble. That is to say, yields compressed first in those gateway markets and then became so low that investors were seeking yield elsewhere, moving out into those sunbelt markets. It remains to be seen, but that's a really interesting observation. And that's not one that we covered in the paper, but it's one that we focus on quite a lot here and are trying to understand what that means. To learn more about our analysis of supply in gateway and sunbelt markets, feel free to click the link below or visit IREI's website. To learn more about Grosvenor, please go to grosvenor.com.